Hello everyone, and welcome to the channel where we explain complex topics. Today we're going to break down a term you hear all the time on the news, GDP. What is it and why should you care? Stick around because by the end of this video you'll understand it perfectly. So what does GDP stand for? It's Gross Domestic Product. That sounds complicated, but the idea is actually pretty simple. Imagine your country is like a giant marketplace. Everything produced and sold within that marketplace over a certain period, usually a year or a quarter, gets added up. GDP is the total value of all those goods and services. Let's break that down. Gross means we're looking at the total number before any deductions are made. Think of it like your gross salary before taxes and other things are taken out. Domestic means we're only counting things made inside the country's borders. So if a German car company builds a factory in the United States, the value of the cars made in that US factory counts towards America's GDP, not Germany's. And product refers to all the final goods and services. Notice I said final goods and services. This is a crucial point. To avoid double counting, economists only measure the value of the final product. And let's use a pizza as an example. To make a pizza, you need flour, tomatoes, cheese, and pepperoni. If we counted the value of the flour, then the value of the dough, and then the value of the final pizza, we'd be counting the flour multiple times. So we only count the price you pay for the finished pizza at the restaurant. That final price already includes the value of all the ingredients that went into it. The same goes for services. A haircut, a doctor's visit, a legal consultation, all these services have a value and they are included in the GDP calculation. Now, how is all this actually calculated? There are three main ways to measure GDP, and in theory, they should all give you the same number. It's like measuring a box by its length, width, and height. Different approaches, same volume. The first method is the expenditure approach. This is the most common one. It adds up all the money spent by different groups in the economy. This includes you and me, the consumers, spending money on things like groceries, gadgets, and movie tickets. This is called consumption. Then there's investment, which is businesses spending on new equipment, buildings, and software. It also includes people buying new houses. Next is government spending on things like roads, schools, and defense. Finally, we have net exports, which is the value of a country's exports minus the value of its imports. We add exports because they are produced here, and we subtract imports because they were produced somewhere else. So consumption plus investment plus government spending plus net exports equals GDP. The second method is the income approach. This one looks at where all the money goes. It adds up all the income earned in the country. This includes the wages and salaries people earn from their jobs, the profits businesses make, the interest people earn on their savings, and the rent landowners collect. It's the sum of all the paychecks and profits generated by producing all those goods and services. The third method is the production or output approach. This one is a bit more direct. It calculates the total value of all goods and services produced, sector by sector. It looks at agriculture, manufacturing, energy, services, and so on. It tallies up the value added at each stage of production to get the final total, which helps avoid that double counting problem we talked about with the pizza. So, we have these big numbers. What do they actually tell us? GDP is the primary way we measure the size and health of a country's economy. When you hear that the economy is growing, it usually means that the GDP has increased compared to the previous period. Economic growth is generally seen as a good thing. A growing GDP often means more jobs are being created, businesses are doing well, and people's incomes are rising. It suggests a higher standard of living. Conversely, if GDP is shrinking for 2 consecutive quarters, that's what economists call a recession. A recession can mean job losses, business closures, and overall economic hardship. That's why governments and central banks watch GDP figures so closely. They use this data to make important decisions about things like interest rates and government spending to try and keep the economy stable and growing. But it's important to understand that GDP isn't a perfect measure of well-being. It has its limitations. For example, GDP doesn't tell us anything about how wealth is distributed. A country could have a very high GDP, but if all that wealth is concentrated in the hands of a few people, while the majority are struggling, is that really a successful economy? GDP wouldn't show you that inequality. GDP also doesn't account for work that isn't paid. Think about all the valuable work done at home. Cooking, cleaning, taking care of children or elderly parents. This is essential for our society to function. But because no money changes hands, it's not included in GDP. The same goes for volunteer work. Furthermore, GDP can sometimes go up for reasons that aren't necessarily positive. For example, after a natural disaster like a hurricane, there's a huge amount of spending on rebuilding homes and infrastructure. This rebuilding activity boosts GDP, but it's happening because of a tragedy that caused immense suffering and loss. Similarly, GDP doesn't consider environmental costs. A factory might produce a lot of goods, which increases GDP, but if it's also polluting the air and water, the negative impact on our health and the planet isn't subtracted from the GDP figure. To get a fuller picture, we often look at GDP in different ways. You might hear about nominal GDP versus real GDP. Nominal GDP is the raw number, calculated using current market prices. The problem is, it can be misleading because of inflation. If prices for everything go up by 5%, nominal GDP might also go up by 5%, even if we didn't actually produce any more stuff. That's where real GDP comes in. Real GDP is adjusted for inflation. It's calculated using the prices from a specific base year. This allows us to see if the economy is actually producing more goods and services, or if the numbers are just going up because of price increases. When you hear economists talking about economic growth, they are almost always referring to the growth of real GDP. Another useful metric is GDP per capita. This is the country's total GDP divided by its population. It gives you a rough idea of the average economic output per person. It's often used to compare the standard of living between different countries. For example, a country with a high GDP but also a very large population might have a lower GDP per capita than a smaller country with a more modest GDP. However, just like total GDP, GDP per capita is an average and doesn't tell you about income inequality within the country. So, to recap, GDP is the total monetary value of all the final goods and services produced within a country's borders in a specific time period. It's a key indicator of a country's economic health and size, used by policymakers to guide their decisions. While it's a powerful tool, it's not a complete measure of a nation's well-being, as it overlooks things like income inequality, unpaid work, and environmental damage. Understanding GDP helps you make sense of the news, understand political debates, and get a better grasp of the forces shaping our world. The next time you hear a news report saying GDP grew by 2%, you'll know exactly what they mean. The country produced 2% more stuff, adjusted for inflation, than it did in the previous period. And you'll also know to think critically about what that number does and doesn't tell you about how people are actually doing. I hope this explanation made the concept of GDP much clearer for you. It's one of those fundamental ideas that once you get it, you start seeing it everywhere. Thank you so much for watching. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe to our channel for more simple explanations of complex topics. If you have any questions or ideas for our next video, drop them in the comments below. See you in the next one.